The worst day on Wall Street since the crash of 1987.
The Dow traders are standing there watching in amazement. I don't blame them.
We're now down 43%.
Almost everything there completely wiped out. And the NASDAQ, everything and more has been completely wiped out.
Let's talk about the speed with which we are watching this market deteriorate.
What are the causes of the 2008 financial crash? The causes of the 2008 financial crash primarily come from deregulation, loose lending standards in the housing market, securitization, and the credit crisis from CDOs. From the mid-1980s up to 2007, there was a period called the Great Moderation, which was very optimistic. However, assumptions about economic growth contributed to this period of deregulation and caused a depression era. Loose lending standards in the housing market was also a primary cause of the financial crash. Specifically, subprime mortgages, which are giving mortgages to people with low credit ratings. A nickname for this is called ninja loans, which stands for no income, no job, and no assets.
Actually, could I talk to a mortgage broker? Anybody you recommend? Anybody you like?
Yes, I have someone, absolutely.
Yeah, bitch better like me. Send her ass to Cabo. So is Morgan Stanley recruiting us? Is that?
Oh, no. No, the bank owns our hedge fund, but we're not really a part of it. We invest in financial service companies, and we're trying to understand the residential mortgage business.
How many loans do you write each month?
About 60.
Yeah. What was it 4 years ago?
10, maybe 15.
Yeah, I was a bartender. Now I own a boat.
You own a boat. So how many of these are adjustable rate mortgages?
Well, most.
Oh, yeah?
Yeah, I'd say about 90%. The bonuses on those skyrocketed a few years ago. Adjustables are bread and honey.
So do applicants ever get rejected?
Seriously? Look, if they get rejected, I suck at my job.
Even if they have no money?
Well, my firm offers ninja loans. No income, no job. You know, I just leave the income section blank if I want. Corporate doesn't care. These people just want homes, you know, and they go with the flow.
Good for you.
Your companies don't verify.
If I write a loan on Friday afternoon, big bank is going to buy it by Monday lunch.
Yeah, same here.
Could you hold on a second?
Yeah.
I don't get it. Why are they confessing?
They're not confessing.
They're bragging.
Securitization is when mortgage lenders package subprime mortgage loans and resold them to make money off of the real estate industry. Collateralized debt obligations, CDOs, are where investment banks started repackaging and reselling mortgage-backed securities on the secondary market. This caused investment banks and institutional investors around the world to borrow significant sums at low short-term rates to buy CDOs. Then, banks used credit default swaps, also known as CDS, which is another financial derivative to insure against defaults on CDOs. Banks and hedge funds started buying and selling swaps in unregulated transactions. This stemmed a credit crisis because those who had committed heavily in CDOs saw their entire balance sheets decimated. Therefore, it was unclear where all these toxic securities were, given that the packaging and repackaging and those whose balance sheets were harboring were unknown. Banks started charging high interest rates to lend other banks and institutions. On September 15th in 2008, the Lehman Brothers, a Wall Street investment bank, filed for bankruptcy. This was the initial start of the 2008 crisis.
Lehman Brothers is going bankrupt, and financial markets from Asia to Europe are doing their utmost to prevent Monday from turning from dark to black. Employees of America's fourth largest investment bank saw the writing on the wall late Sunday after talks to pull them back from the abyss collapsed. British firm Barclays Bank said no thanks, while Bank of America decided instead to help another struggling bank, Merrill Lynch, in a merger deal worth over $50 billion. The U.S. government said it won't bail out Lehman, which last week announced more than $3.9 billion in losses. Shares in Lehman Brothers have plummeted more than 80% in 2008 alone.
Lehman, like so many other investment banks and banks, really got, quite frankly, caught up in the housing bubble. But like every bubble, the bubble ended, and now we're seeing the downside of that bubble.
Following the same risky practices that sunk former giants Fannie Mae and Freddie Mac, Lehman also had a hand in securing America's high-risk subprime mortgages, believing that the popularity and sheer volume of those loans would net huge gains. But it didn't. Borrowers saturated the U.S. housing market, taking on enormous mortgages in spite of poor credit history. As the economy cooled, Americans found themselves with less cash to spend. Higher fuel prices did not help. The result was that more Americans began missing their monthly mortgage payments. As Lehman Brothers secured many of those mortgages, the result was more than $60 billion in losses.
The consequences are very significant. The economic recovery began in 2009. There was no growth in GDP, wages, capital investment, and productivity, and it continued to lag for almost a decade and still today. In November in 2013, Larry Summers, President Obama's top economic advisor, suggested the term secular stagnation, meaning that there's a negligible or no economic growth in a market-based economy. The combination of increased expenditures and decreased revenues resulted from the crisis in 2008 and cost the United States government well over $2 trillion, more than twice the cost of a 17-year-long war in Afghanistan. Also, a 2018 study by the Federal Reserve Board found that the crisis cost every single American approximately $70,000. What is the regulation system to make sure that this doesn't happen again? The U.S. government had two immediate responses: the Troubled Asset Relief Program, also known as TARP, which helped stabilize the economy initially by purchasing $700 billion in toxic assets, with most of the money used to bail out troubled banks. The second one is the American Recovery and Reinvestment Act. This was a stimulus package enacted in 2009, implemented a series of tax cuts, government spending mandates, loan guarantees, and unemployment benefits to help kickstart the economy.
Thanks, Obama.
In the U.S., when the government rescued major American banks, it didn't fire one of their CEOs. The bailouts did not prevent the banks from generously paying their executives and paying dividends to their shareholders, rather than retaining capital to increase their stability. When GM and Chrysler, two automotive powerhouses, were bailed out, their CEOs were fired and their unionized workers were forced to accept substantial pay cuts, even though they had nothing to do with the cause of the crisis. One of the largest regulatory responses in both the United States and the United Kingdom is the overall global improvement for crisis prevention. Development banks developed as one of the solutions for helping economies. The global financial crisis of 2008 had brought the role of development banks and development finance institutions, given that private investment has remained muted in the aftermath of global financial crises. The demand for public funds has increased in developing countries. Development banks can act as catalysts in mobilizing development finance and help in bridging financial gaps to achieve the SDGs. The United Nations defined development banks as financial institutions set up to foster economic development, often taking into account objectives of social development and regional integration, mainly by providing long-term financing to or facilitating the financing of projects, generating positive externalities. Some of the key aspects of development banks include transparency, well-functioning legal and regulatory institutions, clear mandates understood by a whole corporation, strong internal control, among many other solutions. Development banks brought along capital controls and macroprudential tools. Macroprudential policies ensure the stability of financial systems to prevent substantial disruptions in credit and other vital financial services necessary for stable economic growth. They fostered international cooperation, with advanced and emerging economies should realize the need for global policy coordination because of the financial market volatility can generate significant spillback effects on their economies. Another effect was financial transaction taxes. Most estimates show that a U.S. FTT could raise between U.S. estimates show that a U.S. FTT Most estimates show that a United States financial transaction tax could raise around $35 billion and $100 billion annually. This would reduce the federal budget deficit. A United States federal transaction tax may also encourage other countries to adopt a similar tax, thereby reducing the scope of tax avoidance if both the United States of America and the European Union agree on tax harmonization. International cooperation on the financial transaction tax is also feasible in the long run. There are many differences between the United Kingdom and the United States with both respect to private and public sectors. Within the United States, the private sector began to decline in December of 2007, but rebounded in June of 2009. Banks had to endure an interbank credit freeze. Not even healthy credit customers, including businesses, could secure loans. In turn, businesses were forced to reduce their investments and expenses because many of the customers were now employed. Businesses applied for government bailouts, sought mergers, and even filed for bankruptcy. As mentioned before, GM and Chrysler declared bankruptcy and had to accept partial government ownership through bailout programs. Consumer confidence was reduced and spending decreased. Unemployment increased to 9.5% and real GDP decreased. In the public sector, state and local government employment declined slower, with the brink of the losses in 2011 and 2012. They staggered behind the private aid sector numbers because the public sector declined slower than the private sector did. The American Recovery and Reinvestment Act, ARRA, provided funds to create and preserve jobs and to extend or expand employment insurance and provide food stamps. Poverty among both children and adults reached 22%, a 4% increase in the poverty numbers. In the United Kingdom's private sector, large fall in retail sales were seen throughout the country. Businesses with falling sales and profitability face increasing problems in securing bank support for continued trading. Many well-known brands went out of business and had to close a substantial number of stores. MFI, Woolworths, and Blacks are a few. In the public sector, unemployment rose in the ages 18 to 24. The fall in retail sales coupled with a rise in unemployment meant the falling of tax revenues for the government. The fourth quarter GDP in 2008 fell by 1.5%.